Hi, everybody. Let's talk about the buy before you sell program that I mentioned last week. 56% of repeat buyers use funds from their departing residence for their down payments. Basically, what this program does is that it unlocks the equity and removes the sale contingency while they're under contract, acting just like a bridge loan, but a lot more streamlined. It guarantees that it will buy the client's departing residence if it doesn't sell within 90 days after you close on your new house. If the program ends up buying the house, it will use you as a realtor to relist the house for them because they don't want to keep that house. This program will also offset the mortgage liability, remove sale contingency, unlock the equity, not just for the down payment, but minor repairs and upgrades on the departing residence. It can also cover the mortgage payments as well. And this could be an excellent program for our clients that want to find a place that they want without the stress of putting their current residence on the market and trying to sell it as soon as possible. The bond market has been very volatile lately. You have probably heard of the Silicon Valley Bank crash last Friday. The bond market took a huge hit, and usually that means lower interest rates. But surprisingly and unfortunately, we didn't see that this time. Since the beginning of this year, being a first-time home buyer with a conventional loan has been a big deal. Before, the rates for first-time and repeat home buyers were the same, but not anymore. Today's rate for a repeat home buyer with a 10% down payment on a conventional loan would be around 7.5%, the same as last week. If that same person is a first-time home buyer, meaning that they weren't on the house title in the previous 3 years, their rate would be 6.4%, which is a huge difference. Not being a first-time homeowner in this case would cost you $300 a month. To avoid that pricing adjustment, we need at least one person on the loan to be a first-time home buyer and then fall into a specific income criteria. And in most cases, they need to make less than $140,000 a year combined for the Denver Metro. In some cases, we would need to add a spouse without any income to title just to get that first-time home buyer status, assuming that she wasn't on the title previously. Thankfully, FHA doesn't have that rule, and as of today, their interest rate is 5.6%. With the lowered FHA mortgage insurance, it is a much more competitive product for our first-time home buyers with the minimum down payments. Next time, I want to talk to you about the infamous buy-down programs and what you absolutely need to know before you write the contract. Please give me a call if you have any questions. I'm always available. Bye now.